Sam Hendel is president of Levin Easterly Partners, a contrarian value manager, which has $5.5 billion in assets under management. So before we get to what you like here, maybe some value names that we should poke around in, just talk about the market overall and what we're seeing here, because it's been a very interesting 2020 so far. And we've had volatility come back in here. We seemed like we were in a little bit of a corrective phase, back to all-time highs. Where do you think we are right now?
Yeah, I mean, I think certainly it's been a roller coaster with the market. We started January very nicely. Then we had the coronavirus, which is a major exogenous risk that I still think isn't fully priced into a lot of securities at the moment. It's not really understood. I mean, it's clearly a human tragedy, but it's, you've had a number of companies talk about some of the issues of the virus. And then this week, we've had a rally of 3.5% back, and everyone's forgetting about it. But I think really overall with the market, it's the accommodative Fed policy, just the amount of money flush in the world, whether it's in the EC, whether it's China, today cutting the tariffs and probably trying to stimulate their own economy. The federal banks really have a put in the market. So every time it goes down, I just don't see a scenario this year where you're going to have the Fed raise rates or anything like that. So it's going to be a very accommodative market. But meanwhile, we have coronavirus, which people don't understand, and we have the politics, which we're starting to see the primaries come through, and that is another risk in the market.
And Sam, I want to just ask broadly about your approach as a value manager in 2020, because I think people hear value, they say, oh, it's Buffett Graham, you read Intelligent Investor, and right, you figure it all out. I mean, when you think about having a value approach, is it just saying, I want to buy good businesses at low prices? Is it looking at different ways to value companies? Is it cash flow instead of earnings per share? Is it operating income instead of a low PE? I mean, how are you looking at things? And is it different than the way most people would conceive of a value investor?
Sure. Well, one, I would say we're at the all-time wides, going back to the dot-com bubble, in the relationship between value and growth. So we're at the historic wides in the forward PE multiple. And even though the stock market's at all-time highs, we think there are a tremendous number of companies that are undervalued, and we're still finding tons of things to do. So the way we think about value, we really have three pillars of our business. Going back to 1982, when John Levin founded our predecessor firm, it was buying good companies that were down in value, so we're cheap on a free cash flow basis. They had to be down in price. So we're buying companies that are contrarian in nature. So the market must be thinking something, and we have a different point of view. Typically, the stock is down about 15 to 30% from peak. And then number three, in our view, stocks can stay cheap for a very long time. There has to be a catalyst to unlock to really change the way people think about the company. So we are really hunting for those catalysts in these cheap stocks. And those three things, value, contrarian, catalyst, have been the pillar of our firm for 38 years now.
So what are you finding right now that has some value?
Sure. So it's really across every sector. There are names that are out of favor, and I can go through AbbVie on the pharmaceutical side. Earnings tomorrow there, but that company is very cheap, and actually reminds us a lot of Pfizer about 12 years ago when Lipitor was coming off patent. And the stock Pfizer was trading at about 7 times free cash flow because people thought, all right, there was a huge earnings cliff here. And AbbVie is facing the same issue, trading around the same multiple actually, with Humira coming off patent in a few years. But they're doing a lot of things to fill that hole in the earnings. So that's on the pharma side. And then DuPont is a very cheap stock. We have Ed Breen is the executive chairman there, who's breaking up the company, and we think there are a lot of value levers to play there. General Motors, Comcast, AT&T. There are a lot of cheap stocks out there.
Yeah, well, I want to ask about a couple of them just because they've come up in various conversations with value investors. General Motors is one of those that everyone says it's got a ton of cash, it's great business, and it's perpetually traded, I think, at a multiple that a lot of folks think is inappropriate. It should be valued higher. I mean, you talked about those three pillars of what the catalyst might be. When you look at a name like a General Motors, and AT&T is one we've talked about in the media space here. What are those catalysts? Is it an acquisition? Is it a spin-off? Is it what sorts of things are you guys looking for there?
Sure. Well, one, if we compare what's happening with Tesla to General Motors looks extremely cheap. I certainly can't explain that one. But I can't explain the stock price on Tesla. But General Motors, we really look at it in three parts. You have the Auto 1.0 business, which they make trucks and SUVs. And so they don't really make any money on their sedan business, and they're actually restructuring to take a lot of the capacity out of sedans and focus on the areas where they really make money, which is trucks and SUVs. And that business generates about $5.50 in free cash per year. You have a business called GM Financial. So when GM went bankrupt back in 2008, they spun off Allied Financial, which was the old GMAC. And GM's financing arm has been, anytime I lease you lease a car from GM, you're getting a lease from this financing arm. And what's great about GM is they've had this captive unit which has been giving loans, but they haven't dividended up any capital up to the parent. So last year was the first time, because they've been building the capital base there, they finally dividended a little up to the parent. And we think that dividend is going to continue to rise in the next few years. And that's a big catalyst to the stock. So there's a lot of cash flow coming upstream there. And then the biggest one is Cruise Automation. They have a business within GM that they've raised capital in the private markets. The GM Cruise Automation, it's been SoftBank, Honda, and T. Rowe Price have valued that unit at $19 billion. And if I take the value of what I think GM Financial is, which is about $8 a share, the private valuation of Cruise Automation, which is about $12 to $13 a share, maybe even more, I'm buying the rest of GM, that $5.50 for about 2 times free cash flow, and they're doing a restructuring, and I think that free cash flow rises significantly over the next few years. A lot of catalysts there.
There's your catalyst. Value's not dead, I guess. Good to know. Sam Hendel is the president of Levin Easterly Partners. Thanks so much for coming in.
Thank you very much, Jen. Thanks, Mom.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.